You are watching the weekly market overview on IFC Market YouTube channel. In the first week of April, European currencies, the Swiss franc, the euro and the British pound regained some ground against the US dollar, having strengthened by 1.8%, 1.6% and 0.9% respectively. The Japanese yen was an outsider among the six majors, having dropped by 3.5%. The dollar index lost 0.6%. Meetings of central bankers were definitely the major events of the previous week. The Reserve Bank of Australia, the Bank of England and the European Central Bank left their monetary policies unchanged, but the Bank of Japan, despite all the caution taken by markets, still managed to surprise them. Now, instead of targeting the overnight interest rate in order to accelerate inflation to 2%, the bank switches to monetary-based expansion target with a pace of 60 to 70 trillion yen a year. So by the end of 2014, the base can be doubled. The amount of government bonds on the balance of the bank will increase by 50 trillion yen a year, and by the end of 2014 will more than double. Moreover, bonds with any maturity will become eligible for purchases, so that the average maturity of holdings will be increased from 3 years to 7 years. In addition, the purchase of risky assets of 31 trillion yen a year was announced. Decisions of the Bank of Japan caused a rapid rally of the dollar-yen currency pair, which has gained 350 points within a few hours. Today, the dollar has already reached the 46-month high against the yen at 98.84, aiming at the psychological barrier of 100 yen and the 4-year high at 101.43. At the end of the week, another surprise came from North America. The March employment data in the USA and Canada were much worse than expected. The number of non-farm payrolls in the US was only 88,000 instead of the expected 200,000, though unemployment fell slightly to 7.6%. The dollar immediately began losing ground against the major currencies. But despite the obviously disastrous data for March, we would like to note that there were also positive aspects in the report, because the figures for January were revised upwards by 29,000 and for February by 32,000 to 268,000. Thus, the 6-month moving average of the indicator is still close to its yearly high, and we would not rush to conclude that the poor results in March dashed all chances of an early reduction of quantitative easing in the US. Speculations on this subject are likely to continue and will still remain a mid-term factor supporting the dollar. In this regard, the minutes of the March Fed meeting can be interesting, which will be published on Wednesday. Indicators of market sentiment calculated on the basis of the US Commodity Futures Trading Commission data showed that the expectations of the futures market participants before the meetings of the central banks last week amazingly parted with the outcome of the meetings and the following movement of currencies. Remarkable is the growth in net speculative short positions on the euro, which even exceeded the amount of the net short positions on the yen. In general, market participants continue to hold net short positions on most major currencies, except the Australian dollar. We believe that the risks for both the euro and the British pound continue to be high as in the past. In our view, there are several closely settled resistance levels just above 1.30 for the single currency. We will also follow the statistics from Europe. It is not very encouraging yet, and if not immediately but in the coming months could force the ECB's Governing Council to take actions. It is also worth paying attention to the minutes of the Bank of England on April 17. We expect a gradual shift toward easing bias support. Meanwhile, the pound also came close to an important resistance against the dollar, the level of Fibonacci 61.8% in the area of 1.54. So this was market overview, and do not forget to subscribe. subscribe to our YouTube channel. Follow us every Monday. Bye.